So we go ahead and populate the T3 application with Disney. The share price was $94 roughly on December the 12th. I sold the $88 strike, and I got filled with a $1.80 on the premium, which brought the implied vol up to 40. That brought in on a single contract $180, and my break even would have been $86.20. But I've got this closing at a hypothetical 88. So once again, the share price closed at 88 with the strike price being the same as the share price on the options expiration. I'm just modeling on a go-forward basis. The purpose of this quick tutorial is just to show you the power of the metrics that are built into this application. We're going to focus on the top left chart, which will be our risk-reward profile chart. So stock was at 94, sold at 88. I got filled at $1.80. That brought the implied vol up to 40. On a single contract, which is the same as 100 shares, brought in $180 in credit. And I'm just going to assume that at the end of the 30-day option cycle, the stock finished at exactly 88, which was the same price or the same strike that we sold. We're also going to assume that this option expired worthless and there was no assignment. Next, what I'd like to do is turn on the start price. We're going to begin populating this top left chart, which is the risk reward profile. Start price was at $94, and I'm also going to turn on the chart support level, and I've identified that at around $85. That was a support level I identified on Disney stock. So I go ahead and put that on, and if you look up here, it says chart support level. It's currently at 75, but if you use the spinners, you can manipulate the price, and there we go, we've got it at 85. Starting price, chart support level. Next, we're going to turn on the progressive leg break even, followed by the ending stock value at the end of the 30-day period. Now we're going to change the outcome from expired worthless to took assignment. And immediately, the T3 application is designed to drop down to step 2, which is a two-part step. There's a 2A and a 2B. 2A is we're selling a call against the shares that we were assigned, so we had to buy the 100 shares. And then step 2B is we're going to sell another put contract to acquire more shares. This is just a fancy way of dollar cost averaging in by taking assignment. Again, I've left all the strike prices the same. I've left the closing price at the end of step 1 the same as the strike price, which is 88. And to begin step 2, 2A and 2B, we use the $88 carry forward price from the end of step 1. The next indicator that we want to put on is the BE, or break even points start. So I'm going to turn that on, and what this is showing is at the beginning of each step, where do we stand as far as how many points are we above or below our break even. In this case, we're above. All we've done is collect $1.80, which is denoted right here at the beginning of step 1, and this is on a cumulative basis. So what I'm going to do is add $3.64, which brings it to $5.44. And then with the sale of the second put contract, step 2B, we're bringing in an additional $3.45, which brings the break even up to $8.89 away from our break even. What I'm going to do is change the implied volatility. All I want to do is just try to round out these premiums. So I'm going to change, if you notice, it was at 35 and 35 on the step 2A call sale and step 2B put sale. What I'm going to do is I'm going to change the implied volatilities to 39 and 40. And I'm just doing that to try and round out the numbers to a whole number as close as possible. So on the 2A call sale, with a 39 implied volatility, we're bringing in 404 in premium. And on the 2B put sale, with a 40 implied volatility, we're bringing in $3.96 in premium. If you add those two together, you come up with exactly $8. 404 plus 396 makes 8. And if you add the $1.80 from step 1 that we collected, you have a value of $9.80 or $9.81, since this application is rounded up. That is the premium that you have collected, and that is how far away you are from your break even. This gives a trader a great advantage to know where he or she is looking to sell certain strike prices and how far the stock can move against them without risking their break even. Next, what I'm going to do is I'm going to add the break-even points end. So at the end of the 30-day cycle, we have no idea at the beginning where Disney may finish off. Again, hypothetically, it's at 88. It could go to 108, At the end of 30 days, it could drop down to 80. We don't know. Once again, I've just populated it with an actual $88 closing price, which ending value populated with 88. Not very realistic, but bear with me and I'm going to show you how this application is designed, and you'll be able to see where you stand at both the beginning of every step and at the end based on variable closing prices, which are user defined. As you can see, I'm going to increase the ending value from 88 to 89 up to 90, and the entire graph changes as we manipulate the ending value. It's very important to note the premiums collected are constant based on the closing price from the prior step. The changes you'll see will be in the closing price, not on the premiums collected. So here we have step 1, and the beginning and ending price are the same. Here we have step 2A. This is the call sale. It's denoted right down here. And this is step 2B, the put sale. We have our break even in orange. We have the ending stock value in black. We have the premium that we have collected, or the points to break even, in the light blue. Once again, if I manipulate the price, you can see everything reflects in the graph, so you know where you stand at the beginning and at the end of each successive step within the strategy. Let's return the share price back to the 88. So the hypothetical ending value is exactly the strike prices that we sold on both the call and on the put. But now what we're going to do is change the call from called away to expired worthless, and we're going to assume we took assignment when the share price closed at $88 at the end of step 2. Was here at 88 and we had the share prices called away, and now we've got it back to 88, but now we're going to have the calls expire worthless and assume that we took assignment. And when we do that, one application uses a rinse and repeat approach, and we drop down to step 3 within the strategy. We have now taken on 100 shares at the end of step 1 and an additional 100 shares on the assignment of the second step 2B put sale. So we are now long on a cumulative basis 200 shares. We drop down to step 3. The carry forward price to begin step 3 is 88. Again, that was the closing price at the end of step 2. And you can see the graph is populated with step 1, step 2A, step 2B, and now step 3 has been added. In step 3, there are no more put sales. We now only will sell call contracts going forward to put up for sale our 200 shares long that have been assigned to us. Again, we're going to sell the $88 call strike with a 39 implied volatility, which is the same as it was in step 2A on the first call sale. 39 implied vol generates $4.04. This time it's on 2 contracts or 200 shares, which brings in $809 in cash flow. At the end of step 3, I've got a hypothetical $92 a share, and if that were to happen, then of course the real power of this application is the what-if modeling capability. If I go back and change the closing price or the ending value in step 2 from 88 down to 87, we had sold the $88 call strike, closed at 87 hypothetically, which is $1 less than where we closed at the end of step 1. Take a look at how the position ends, which is in black, at the end of step 2. This is technically step 2B. We do not show an ending value at the end of step 2A because step 2 is a 2-part step. So we sell the premium for the call side, we sell the premium for the put side, and then we have a single close for both step 2A and 2B. And as you can see, a single dollar drop in the closing price from 88 to 87 has us losing or moving us closer to our break even. We are now only $7.81 away from our break even, whereas when we started the trade at the beginning of step 2, we were $9.81 away. This is because we had already taken the assignment of shares with an $88 strike. So we have now given back 1 point on something that we were already long on. So we lost a point there on the first assignment, and the second assignment was also at $88 a share. And if we took assignment, and we did in this example, we are now down a single point as well on the second assignment for a total of 2 points, which is why we dropped from $9.81 in credits, or $9.81 away from our break even, down to $7.81. That's because of where the share price hypothetically closed at the end of the. Here we are with a 2-point drop down to 86. Here's a 3-point drop down to 85. And as you can see, the closing price of 85 is reflected here in how many points we are away from our break even. We started the trade in step 2 with the calls and the puts being with a $9.81 credit or $9.81 away from our break even. But because of Disney's hypothetically dropping from 88 down to 85, we've given back $6 exactly in points away from our break even. So this is getting closer to our break even, which we ideally don't. I'm just going to increase the implied volatility from 39 up to 40, and you can see that is reflected in both the opening and in the closing. So 771, and we're picking up an additional 10 cents in premium, and it is always reflected in our credits at the beginning of every trade and at the end. 39 right here, and step 3 was our implied vol. If I raise that up to 40, there we go, and we've got a $4 premium that is to be collected at the beginning of step 3. $85 is the hypothetical opening price because that is a carry forward price from where we closed at the end of step 2. $85 is the opening price, $85 is the call strike that we are selling, with a 40 implied vol generates $4 in premium. Times 2 contracts, there's $801 more in cash flow. I want to focus on not just where we start the trade, but where we finish it 30 days later. And that is all dependent on where the share prices finish at the end of the 30-day cycle. If I drop the price from 85 is a hypothetical closing price, it is the same as the actual strike price that we sold, which is the same as a starting price, which was a carry forward from the hypothetical closing price in step 2. But if we drop this from 85 to 84, immediately in step 3, right here, step 3, call sale times 2, it drops from 781 in credits down to 581 in credits, or $5.81 away from our break even. That is because the share price dropped from 85 to 84, a $1 loss from the previous step. Because 84 is the ending value, that is 1 point less than the strike price that we sold on the call side in step 3. The shares would of course expire worthless, and by default the application, once rinse and repeat, drops down to step 4. And we have our credits that we collect at the beginning of step 4, and we have an ending value. And I think you're starting to see the progressive nature of this trade. And this is where this tool excels. We can run what if simulated trades in advance and match it up against a price chart. And we could determine what we might be able to sell in the way of volatility at certain strike prices based on closing values the step prior. So we've got an $84 closing price, option expired worthless. That becomes the carry forward opening price for step 4. So we're going to sell an $84 at the money call with a 41 implied volatility, generates $4.05 in premium. That's $810 on 2 call contracts or 200 shares. Again, I've got this populated with an ending value of 84, the same as the current strike price for step 4, the same as the opening price at the beginning of step 4, and of course that was a carry forward value from the end of step 3. And finally, I just want to show that if the stock from step 3 closed, say, 1 point lower than 84, let's drop it down to 83. Immediately, the opening price for the beginning of step 4 becomes the carry forward price from the end of step 3. So this drops to 83. I've changed the strike price to 83, but what you can see is we started at 85 at the end of step 2. And so just to follow on that theme, if we closed at 85 at the end of step 2, we hypothetically dropped down to 84 at the end of step 3, you can see that reflected. Each point dropped will cost us 2 points from the opening points to break even to the closing points to break even right here, because we are long 200 shares cumulatively. We took assignment at the end of step 1 and at the end of step 2B. So each point that it drops is going to cost us 2 points here. We're on step 3, call sale. If we drop it further from 84 to 83, it's reflected immediately in the graph. These are the points to break even at the beginning of step 3. Now, if it hypothetically went to 83, we're only $3.81 away from our break even. This closing price at the end of step 3 becomes the carry forward opening price for the beginning of step 4. Sell an at-the-money $83 call with a 41 implied volatility generates a nice round $4 in premium. That gets added here and it's collected and reflected here in the bluish white candle. And if we just go ahead and scroll forward, we can now take a look at how we're making our profit on a progressive step-by-step. Let's go ahead and add our cumulative trade progression. How are we doing through all of these ups and downs? And at the end of step 1, we were up 180. At the end of step 2A, we had $285. $381 at the end of step 2B put sale. In step 3, we were up $781, and of course in step 4, $1,582, and we're assuming we got called away with a closing price of, or an ending value of 83, which was the strike price that we sold at the beginning of step 4. And we have it populated correctly with called away right here. How would we have done if we had just gone in and purchased shares? Well, that's pretty straightforward. If you went in and purchased 200 shares at $94 a share, and the closing value is 83 when the trade is complete, that means we lost $11 per share times 200 shares, and there you have a $2,200 loss reflected right here. What's the dollar difference? So here the dollar difference has been activated. It's very simple. What did we make versus what did we lose? In step 3, we were up $2,981 as far as dollar difference. What our T3 strategy was up, which was $781, versus a $2,200 loss if you had gone in and purchased the shares, which is what creates the dollar difference of $29.81. When we finally closed out the trade, we had a $3,782 dollar difference, meaning the T3 strategy profited with $1,582. If you had just gone in and purchased 200 shares at the opening price of $94 when this trade started, you'd be down $2,200. And finally, what does that look like as far as a rate of return? What we're looking at here is our rate of return at the end of each step individually. What we're now looking at is our rate of return on an annualized basis. So remember, each interval is 30 days. So step 1 is 30 days. Step 2A and step 2B represent a second 30-day interval. Step 3 is another 30-day interval, and step 4 is another 30-day interval. So 1, 2, 3, over the period of 4 months, if you could repeat this 2 additional 4-month intervals throughout the course of the year, that would be a full calendar year of 12 months, you would annualize a return of 27.21%. And this is a position that had moved against you. Its worst point, 12.15% against where we began the trade at $94 a share. The very last metric is the percentage move protection since inception. It's the yellow or orange line, and you always want to have this line below where the UI is, which is the underlying instrument. So if this is how far drawn down Disney became, which was at its worst point minus 12.15% from the starting value of 94, our break even was always below that. And that is reflected in the very, very final slide here. So when the market was down at its worst, which was 12.15%, or Disney, we were still had a cushion of 1.48% to the downside. And that is as a result of the premiums that we collected and the dollar cost approach that we took in acquiring the shares. How did that compare with an outright stock purchase? Well, here's our annualized returns using the T3 strategy, once again 27.21% on an annualized basis versus a loss of 31.51% if you had just gone in and bought the shares on an outright basis. Thanks for watching.